Hello, everyone, and welcome to this ReOrg webinar. We will give it about 15 seconds for all the participants to log on. Welcome again to ReOrg's webinar on the digitalization of the leveraged loan markets. I'm Benjamin Kovachka, a director in our ReOrg Europe office, and I'm very pleased to host this exciting panel as leveraged loans are something that is very much on top of our minds over here at ReOrg. Leveraged loans run into trillions of dollars globally, and this market is also growing rapidly. However, more than 2 decades into the 21st century, the leveraged loan market stands out amongst other asset classes like bonds and stocks. It's slow, it's inefficient, it's complex, and illiquid in comparison. From origination to secondary trading throughout the life cycle of a loan, manual processes proliferate, and there are many disparate systems, and the data is decentralized. Syndication is done with emails and spreadsheets. Secondary trades are done over the phone and instant messages, and they can take weeks, if not months, to settle. In our age, where a lot of processes happen instantaneously, this part of financial markets is anachronistic, and we should be asking if it's time to ditch the facts. The outbreak of the pandemic has accelerated digitalization in many aspects of our lives. And the question that we will discuss here today is whether the multi-trillion-dollar leveraged loan market is moving also in that direction. So yeah, this is what we're going to speak about today. And with great pleasure, I introduce you to our panelists, Paul Mehta from Aberdeen and Will Nash from LedgerComm.
Hello, Ben.
Paul Mehta.
Thanks, Ben.
Thanks, Paul, and thanks, Will. Paul Mehta is the global head of loans at Aberdeen. He's the lead portfolio manager and in charge of all aspects of investing in leveraged loans across the global platform. Paul has previously worked in BNP Paribas, Bank of America Merrill Lynch, ABN AMRO, and other banks in distribution, structuring, trading credit risk, and portfolio management in leveraged loans and high yield. Will Nash is the founder of LedgerComm, and will spend almost 10 years running HSBC's leveraged credit sales business, distributing loans, high-yield bonds, and distressed debt. Will started LedgerComm with a view that it is agency and loan settlement, not necessarily trading, that were in need of serious overhaul. For the next 30 minutes, we will speak about how to bring efficiency, transparency, and liquidity into the leveraged loan markets, and this will be followed by 10 minutes for questions. Please send in your questions at any time during the webinar.
Yeah, he's cut it down a lot.
And we want this to be a lively conversation. To send questions, use the Q&A widget at the bottom of your screen. Without further ado, let's begin. All right, so the leveraged loan markets have grown exponentially since the last credit crisis. However, as mentioned, this multi-trillion-dollar market is slow, opaque, and illiquid, and some trades are still done by fax. So Paul, let's start with you. In an era where we can buy, sell, and transfer money instantaneously, the leveraged loan market seemed to be stuck in the past century. What issues does this create, and what pain points do you experience as an investor?
Yep, thanks, Ben. Thank you for inviting me on the panel. Morning, afternoon, or evening to anyone kind of dialing in to the webinar. So I think, look, in any tradable market, what you want is a robust market that has transparency, observability, visibility, and liquidity. Those are the key things. Those are kind of the rock bed of all markets. And the tradable institutional loan market actually isn't that old. You know, a lot of people argue it was born kind of the late 90s with KKR taking over RJB Nabisco. So that was in the US. So that's kind of 30 plus years old. In Europe, essentially probably only 20 years old. So we are playing catch up somewhat. As you rightly said, Ben, you know, the market has grown exponentially since those kind of 20 and 30-year-old kind of born into a tradable instrument, and now we're looking at a 2 trillion market. I think the key thing that really is rounded on for the loan market is the cash settlement. So when you trade, say, a loan vis-a-vis a bond, the cash settlement of that loan, whether you're buying or selling, is very protracted, very manual, and ambiguous in terms of you don't actually know when that cash settlement is going to be, which is perverse to say it out loud, but that is the market as it is at the moment. For me as an investor, what that means is, you know, you are you don't have a clear picture of your cash position, and how you may invest will be affected by that ambiguity. So I think it's really goes to the core of how you can invest and your trust and liquidity in the market.
And to follow up on what you were just mentioning in terms of the pain point, and for example, not knowing how much cash you have and when things are getting settled, could you maybe elaborate for me and for everyone else on the panel, exactly what it means, and kind of how is the process right now?
So yeah, absolutely. Let's kind of talk about some examples maybe, and that kind of will focus everyone's minds on how it is in the market. So you say you and I, Ben, we're trading a loan. I'm selling, you're buying. We do the trade today. We agree the price today. As I'm sure a few people know on the call and on listening in, that in Europe it's T+10 and T+7. What does that mean? That means you should cash match and settle each other in that period. And that would happen in most of the markets. The bond market is T+2. So if we're trading a bond, Ben, in T+2, the cash would exchange. Here in loans, it should be T+10 because we're sitting here in Europe, but actually what ordinarily would happen is it would be at least double that length. And to what we were saying before, it'd be ambiguous. We would trade it, and then T+10 would elapse, and we still quite possibly wouldn't even know when the cash would settle. So both sides don't know their cash position, and it only really becomes clear close to the settlement date, which on average in Europe is T+25. So it creates a real kind of issue in terms of how you might invest. I mean, I've had loans in liquid TMT UK names that we'd all know and I've traded with the US investment bank, and it's taken over 50 days to settle. So I sold, they bought. I don't have that cash for 50 days, which you can imagine, whether you're an investor from the high street trying to invest or you're an institutional investor, that's hugely frustrating that cash is getting stuck in the plumbing of the loan market.
In practice, I would imagine this impacts performance, having to hold more assets in cash or pro forma cash, as you referred to it in our previous discussions, right?
Yeah, I mean, you can have it on the other side, as in you haven't settled for something maybe you've done on the other side in terms of an opposite trade, but it doesn't create a clear picture. And of course, it creates other issues. So you're kept whole from an economics perspective as if you did hold that. So there's some extra calculations that need to be done to make sure when it does cash settle, you've got the amount of economics that you would have got as if it had cash or T+10. And then in any market, you always think about counterparty risk, and having a trade open, essentially, which it is, it's contractually agreed, but cash hasn't moved between institutions or through institutions, then you have that counterparty risk prevailing, and that can aggregate to quite a big position. For example, if it's a major trading bank desk, then that can aggregate to quite a lot of counterparty risk on both sides.
And Will, could you give us maybe your perspective on this from when you were at HSBC, kind of the what's happening in the back office, what kind of processes are taking place right now, and what effectively it is that's causing this delay and the problems?
Yeah, thanks, Ben. I think the first thing worth noting is that bank loans were never meant to be traded, right? It wasn't created as a security. And then I guess we got to a stage where cover-like loans or term loan Bs in the US became a much more attractive instrument for sponsors or companies to use, right? And so all of a sudden, just through the demand of the flexibility of the instrument, we've been flooded with supply. And what's not really happened, right, is that the market hasn't really got to grips with how to settle and trade this thing properly. I mean, I don't know who came up with the T+10 concept originally. It seems a bit arbitrary, right? But the way I would look at it, and it's just human nature, right? If someone tells you you've got an assessment or a test at school and you've got 10 days to do it, I mean, you're not going to do it 9 days in advance, are you, right? All you've got to do is create a set of trading documents around it. So it naturally lends itself to, to putting stuff off tomorrow, right? And so, we're now faced with, with a $2 trillion market and sponsors, just issuing more and more and more debt. through the loan market, and that is just creating a massive backlog, right? So what really needs to happen now is, we need the market to catch up to enable people, and more people, quite frankly, to invest in what is a very good, very safe, very low default asset class, right? But is naturally hamstrung by these, quite frankly, antiquated barriers to settlement and to entry as well. You think about what's involved in actually settling a loan. I mean, it's crazy. You need specialist staff. You need, specialist software. It's quite tricky. It's quite tricky.
And one thing that you've mentioned to me before when you spoke was, there's a lot of following up that's required on the people's side to, like, that's really one of the few ways to actually understand where you are in the process, right? To get on the phone. Yeah,
absolutely. I mean, I think if you kind of look at the asset class in numbers, it's pretty crazy. I think you're probably into the high 50s or 60 days on average to settle a loan trade across Europe, which means, I think that puts it longer than physical real estate to trade. Certainly would be this year, given how hot the real estate markets are, right? And so you think about what happens. Paul and I, would do numerous trades together, back in the day, right? We would take us 10 seconds to agree a trade. We would then put the phone down, and then it goes away from us into middle office, back office. That could be onshore, it could be nearshored. The average time for European loan closers to issue trade confirmations is 4 days, right? The average time for you to get approval on a whitelist, and we'll come to that in a minute, because that's focuses on the restrictions around lending to this asset class as well, is somewhere between 7 and 10 days just to get an answer as to whether or not you can come into the club, as it were. Right? So there's a lot of barriers to entry. The market is not making it particularly easy for itself, and I think the idea is trying to introduce not only technology but process change to allow more people to access this. Right?
So clearly, this is a important market. It's an interesting market. It should be available to more investors outside of kind of specialist loan funds. And the question that I have is, why are regulators concerned about this? Are we moving towards kind of the direction closer towards bonds? Is there concern about lack of liquidity that this may be creating? And yeah, ultimately, what is the rationale for the loans being different from bonds, or is this really just it was created as not meant to be traded?
Yeah, I mean, I think, to pick up on your 2 points, there is no rationale why it should be different to bonds. The key difference, clearly, as Will just alluded to there, is it's not a security. So I think he's right in terms of saying maybe it wasn't meant to be traded, but in terms of, as we stand here in 2021, there's no rationale really why it should have this elongated, protracted, opaque process, frankly. It is a tradable instrument. There's exchange of risk, like you're trading, as Will said, real estate or bonds. It should be robust and clear and visible. The regulators have taken an interest in leveraged loans over the last couple of years, particularly because they have been concerned about liquidity. And actually, that's become a hotspot in the US, because in the US you have ETFs that would have loans as their underlying assets. We don't have that in Europe. And part of it is to do with some of the stuff we're talking about today. But they're really concerned about what is kind of quite a retail platform, an ETF, that has less or not as efficient instruments in it or investments in it, like leveraged loans. So I think the regulators are increasingly involved and concerned. And also the size of the market, it's become a lot bigger. So it is arguably more systemic than it was. So I would say the European leveraged loan market has probably doubled since the GFC, since the global financial crisis. So that's creating a big flag for regulators.
And Ben, because I'm a bit of a dork on these things, I can say the European Commission in 2019 did do a report on this, on loan settlement time, and they came back, and you can see all this stuff on our website if you want to have a look at it. But they came back, and one of the key takeaways for us was A faster settlement window would reduce difference between loans and bonds. Investors might be attracted to loans that are senior to bonds, but are currently put off by how long loan trades take to settle, right? So that was when they were looking into all the obstacles to that and what difference technology can make ultimately, right?
Thanks, Will.
It does put off potential investors, and I think to have a deep pool of investors, as in a diverse pool, is always very powerful. And loans doesn't really have that. As Will has said, it's quite specialised. You need some specialised people, equipment, software, etc. My opinion is it shouldn't have to be that way.
And so, so the market is growing. It's attractive, and so we have this issue with settlement and so to speak the plumbing of the market. One of the issues that we're exploring over here at ReOrg is access to information. Obviously, it's another parallel to to the bond market. Access to information in the bond market, in comparison to the loan market, is incredibly easy. It's and again, we're coming back to the fact that maybe the loans were never built in such a way that they should be traded. But if you want to make an investment, access to information is very important. So, Paul, maybe you can share with us your experience and some kind of issues that you faced on this side when dealing with the market. Yeah,
look, I've sat in various different seats where around this issue, to the point, being in a bank, in a portfolio management unit, to kind of sales and trading, and now in the seat I'm in as a portfolio manager. And it has progressed a little bit, being able to access information, and that progression has been as rudimentary as some information portals that they used to literally courier around documents that thick to every potential investor. So now it's uploaded onto a kind of data portal, but that is literally as innovative as we've got, which is basically there, and then you can download it yourself. But in terms of actually accessing that information, it still requires quite often a blessing from an agency team within a bank or an agency team outside a bank. And that can take days, because, as Will, I think, alluded to earlier, you may speak to your trading counterpart in London or New York or wherever, and actually the team that does the blessing of whether you're allowed into even look at the info to see if you want to go into the club might be somewhere else, and so totally disconnected to the process. So we've actually had examples where we actually have not invested in deals purely because it took 4 days to access the information, and the deal's closing tomorrow. And I've been asked the question, "Are you interested in a deal?" I said, "Well, no, we haven't had time to access it." So it's a real life problem. And again, you look at it, bonds. I work closely with our bond team at Aberdeen. There's no reason why it shouldn't be the same. Day one, the bonds the information's available. There are obviously, as I'm sure we all know, public-private elements within the loan market, but I think it could be a lot better about it being accessible to public side investors.
No, I 100% agree, and this is part of the loan market where we have been kind of focused on ourselves. What kind of the problem that we're trying to solve is exactly as you mentioned. You have this issue where if you're trying to buy a piece of loan in secondary market, it takes time to get information, then it takes further time to do your due diligence, and so this can lead to the investors possibly passing up on the trade. And so we're trying to carve this problem into kind of two separate problems, and one of them is timely access to the actual information. So as soon as you're private, being able to access the information, and then once you do have access to the information, to actually be able to digest it in an effective and efficient manner, rather than kind of digging through data room for all the relevant pieces. So that's one of the things, especially on the financial side, that we've been focused on over here in the ReOrg, and we'll mention this in a minute in kind of solutions. And I think this is also a good time to kind of wrap up the kind of the problem part of this webinar and start getting to the solutions. And so, clearly from the discussion that we have had, there are changes required to transform the leveraged loan market, to make it smarter, to make it more efficient. After the pandemic, there's also this kind of sense of dynamism on this front as well. And so, maybe let's start with you again, Paul. What are the big picture solutions that you are exploring?
Yeah, I think one thing we kind of touched on it a little bit earlier is there needs to be a little bit tighter enforceability around if there is a prolonged settlement in secondary. There's no sort of recourse. You know, if I have an issue with that trade that I talked about that took over 50 days to settle, all I can really do is talk to that counterparty, and they give me a rationale, or they don't, or they ignore me, whatever the case may be, but there's no sort of recourse. So I think that, and Will talked about a bit more of a tighter framework around that. There are obviously governing bodies that cover the loan market, which provide guidance, but anything more explicit, I think, would be very helpful. There are some roadblocks that are there. You know, it's human nature. It's just always been a certain way, and so people just continue to do that. But in terms of hotspots of roadblocks, I think a lot of the underwriters and sponsors could insist on certain methodology which would really drive it. So whether that's in primary or secondary, actually, that the shorter settlement or promote that. And frankly, I think once those kind of solutions start to come through, if not wholesale accepted by or adopted by the market, certain sponsors, banks, investors, or solution providers like Will's firm, if people get on board with those and they can see it's a commercial advantage, and it's, you know, you're able to run your loan fund more efficiently, say, than the one at Aberdeen, for example, then that's going to really drive other people to engage and move forward with those more efficient systems.
Yeah, I think I agree, right? And I think it's one of those strange things to try and impress upon possibly some of the most capitalist people and investors in the world, that perhaps they should unionize a little bit more. Do you know what I mean? In a kind of unofficial way, kind of like stand up for your rights as a buy side group, because look, technology can drive a lot of these things, but ultimately, you know, if you get together as a group, you know, you've got trillions of dollars of assets under management, right? You can definitely drive process change in conjunction with the banks. Nobody wants the banks to lose out here, right? But if we're talking, if this is a process, it's the introduction of new technology to help both sides. That has to be the way to move the market forward, surely.
And so Will, when you talk about technology, and you know, also kind of, you know, when you talk about LedgerComm, could you give us, you know, a bit of a background exactly how you're solving all of these issues that we've discussed, and especially on the settlement side, and you know, what are some of the stakeholders that you've had to work with?
Yeah, absolutely. I mean, one great kind of example of something that we're working on at the moment is something you just touched on, right? And the access to kind of data rooms. And data rooms is probably a bit of a kind of a complementary term, I guess, right? Because essentially they're kind of, you know, it's where people just go and dump information, right? There's not a huge amount of ordering or selection, and I kind of know that you guys are doing a stand-up job in terms of trying to kind of standardize that as best you can across the leveraged credit market, which is pretty key given how many different interpretations of EBITDA, I guess there are, right? But I mean, you know, to the example you just gave, you know, if all of a sudden, you know, Paul wants to get access to information, he has to go private on a name. He's struggling to get access to something. You know, that can obviously be done much quicker if you're all on one platform. But also, what does he get? He doesn't know what is on the other side of the wall. So he's making a decision to wall cross his firm and possibly himself, and restrict himself from trading in other securities. And he doesn't actually know what information he's going to get, you know, when that data room is opened up, right? And so a little bit more visibility and categorization and ordering of data can help people make smarter decisions, right? And then really the fundamental basis of what we're doing, and I guess there's a bunch of other participants out there addressing, you know, various bits of it as well. But our focus really is on pre-trade information, right? And that is, you've got the situation at the moment where you can trade with someone not knowing if that person holds the loan you want to buy, if they've got KYC with you, if you have traded the right amount in terms of the minimum increment, right? If your whitelist agreement is going to get approved within X number of days, right? And so having better, more efficient access to information pre-trade can definitely help shorten your post-trade journey, because it's such an impediment to trading this asset class, right? It puts a lot of people off and creates a lot of a lot of opacity as well.
We
I
have a
think
question from, oh, sorry, Paul.
Okay. I was just going to say, I agree with what Will's saying, because you've got to think about what's strikeable in today's world, and a move to much more comprehensive pre-trade checklists just seems a very executable. If you were to try and do it through the whole lifespan, I think it would be quite, to get there, I think it's something that's strikeable and should be definitely be rounded on by the market.
We have a question from an audience, and I think, Will, you've touched on this, and I'm happy to provide, to kind of take this question with you. So could settlement and info transfer be combined at the point of trade? So there's no delay, for example, getting an info piece. And is there a way to kind of summarizing info so people spend less time rummaging a data room jumble sale? So why don't you start? And I'm happy to kind of take also kind of the financials part of the question and kind of offer thoughts on a couple of things that we're doing on that side.
Yeah, sure, absolutely. Look, I think it's definitely the solution that we are focused on, right? In terms of trying to make information provision from borrowers to lenders much more transparent and much more meaningful as well. So you may have a set of covenants, say you're lending to an Italian football club, right? And you've got a coupon ratchet that starts at 6%, but all of a sudden you finish 15th in Serie A, and all of a sudden you're paying 10%, right? So you have these kind of weird and wonderful things that operate in the loan market that you need more customization, but also you need the ability to process that customized data from end to end. Does it work on individual transactions? Yeah, absolutely. But I think Nirvana is getting a piece of software out there that every agent bank can use and provide as near as damn it to uniform data to the investor base, be it through ticketing or be it through pre or post trade checking, or automating distribution of fees and interest accrual and all that kind of stuff, right? It's dragging the whole process into the 21st century.
One thing that we're doing in terms of access to the information, especially on the financial side and covenant side, through our product called ABRDN, is we're basically working with investors, whether it's CLOs or any other investors in the leveraged loan asset class, and we basically on a gift to get kind of a model, we source the financial information for all of the issuers and create models on the back end in the same way that you would have financial models for bonds out there to as soon as you wish to have a look at the model, it is there. Of course, on the loan side, it's a bit more complicated insofar as you actually need to go private to get access to the information. But the problem that we're trying to solve is as soon as we know that you are private, and to the extent that that we have access to the information through one of our partners that we're working with, you can get immediate access to the information that we do have on the platform. And so, one, you do not have to spend the time trying to get the access to the data room through an agent, and two, you don't then have to spend significant amount of time actually building a model, spreading out the financials and understanding. So what we're trying to do is kind of shorten the due diligence time. And similarly, we have had solution for a while now on the covenant side, where in the same way, as soon as we know that you're private to the loan, we can share our covenant analysis for the particular loan, and that would just be with the parties that are private to the transaction.
Yeah, I think that makes sense, right? Because you think about, and Paul, you'd be able to correct me on this, but what percentage of overlap there is in terms of holdings across European loan funds or CLOs, right? And so there's almost an element of kind of indexation, right, isn't there? And so I guess if you think about, you have to be long, you have to be invested. That's just the way. That's what investors pay you to do. If you can get all of that data aggregated, you can then focus your alpha focus can be on that 30, that 40%, of credits that maybe aren't held by by everybody else. Right?
And so one more question from the audience. So where do we start? As a group of agents using a common digital platform, the point of start, or do you need a group of trading desks? Will new deals just be digital? What's the journey that you faced, Will, and what does your roadmap look like, basically?
Yeah, I mean, absolutely. I mean, I think that question touches a little bit on I guess the possibility of replacing some of the existing very good software that is out there, right? And obviously the software that is out there, some of it operates practically in a monopoly, right? And it's a very strange situation to be having to have a kind of $2 trillion market where there's essentially one monopolistic provider of services to the large part of the market, right? So we obviously have started this business thinking that there could be at least room for two, and that some of these things can be approved on. The hardest part of any new business is getting buy-in from people, and I think there's one thing having a piece of tech; it's another thing having it out there and being able to be used by people, right? So we were able to get our first transaction on board and over the line in August this year. And the nature of the market in Europe, and I guess the States, is essentially an oligopoly, right? And so you think about how many people, how many banks and funds there are out there to be lenders to individual deals. That through 3 or 4 deals, you can probably capture a very large percentage of the lending agent banks, be it through RCFs or term loans, and then a lot of the specialist loan funds as well there, right? And so the uptake, from there is a question of comparing, what you get now versus what can be improved upon, and then taking it from there, right? Part of it probably has to be looking to reduce transaction fees as well. If you're making things more liquid, if you're making things faster to trade, should it cost €3,500 or dollars to do a trade? It's the most expensive market to trade in the world, right?
Yeah.
So it's expensive, it's illiquid, it's opaque, got a lot of things going for it.
I think
come one, come all, yeah.
I think what we're talking about, Ben, it's not the first time it's been addressed, but dangerous thing to say in finance, but this time it's different. I think because, like Will's saying, the technology has caught up with the problem, and so now it's much more. There is a solution there. Where this has been an issue for a while, the settlement, the opaqueness, and all the stuff we talked about, the transfer fees. But now, given we sit in different jurisdictions, sometimes maybe teams don't sit together because of the last 18 months, 2 years. And technology's moved on generally in the world, but also just how people perceive it and what's available to do, I think means it really is the right time to do it. And there's going to be more focus on this product because it's a floating rate product. More investors are going to be interested in exposing towards that, given the interest rate environment. So I think now's a really critical time to kind of really bed in these kind of better practices, because I expect the market's probably going to get a little bit bigger and have more diverse investor base.
And do you see, do either of you see someone who will, fight to stick with the status quo, or what will be the challenges from kind of the incumbent system?
I think everyone's, for my mind, just thinking across all stakeholders, I think everyone's probably got the right intentions. Maybe there's slightly different motivations on speed. I used to work in banks. Some of the banks have quite entrenched systems and methodologies of doing things that I could probably see them maybe of the whole value chain maybe being a little bit less speedy than say the investor base, where you can quite clearly see if you had more liquid market, less transfer fees. Obviously, I'm going to deliver more for my clients, which ultimately might be someone's pension fund. So I want to do that, and that's my day-to-day job. That's what I should be doing. So I'm going to keep pushing on this. So yeah, maybe some of the banks might be less pre-positioned to move forward. Although I think they also spend a huge amount, and will know more than me, a huge amount of management time and people power on this, when they'd probably rather be doing something a little bit more commercial, frankly.
Yeah, I think one of the most amazing things would be that, you would do a trade and then, would leave your desk and you just simply, clients would phone up. And you would ask for some kind of visibility on where the trade was and why you just wouldn't know. It's like, so a little bit more kind of transparency from that point of view, and auditability, I think, certainly won't hurt anybody, right?
Thank you so much, Will and Paul. I think at this point we are going to open the panel to questions from the audience in the Q&A portion of this panel. We will take 30 seconds, collect any question that you may have, and we'll get back to it shortly.
Ben, I think there was a question about private module.
Yeah, would you like to
I'm very happy to take that one. And I think if someone's asked a question, would it be possible to add a private module into Bloomberg to allow a trading, booking, ticketing system that's familiar to many people who trade bonds? And I mean, yeah, absolutely. I think that's probably one of the ways that the market goes, because on any individual name, you have to be able to know exactly where you are, if you're public on a name, if you're private on a name. It's kind of one of the reasons why Bloomberg, as soon as a loan is created on Bloomberg, you get a snapshot at creation, but obviously what happens after that is syndicate level or private information. And so it's kind of useful having the information, but it certainly won't be 100% accurate from that point of view. And so having people who are comfortable being private on certain names and being able to access that accurate information in real time, I think is something that look, banks will probably have to deal with that. Most banks have loan and bond groups hived off onto separate floors or in separate pods as well at the moment these days. And so allowing that access to real-time, more accurate information, I think, is a really good idea.
Thanks, Will. Paul, one for you. So would you or an institution such as Aberdeen consider using a group like LedgerComm for Aberdeen's trades, and what are your concerns, and how would you go about kind of changing the status quo?
I would absolutely, not because Will's sitting there. I would absolutely. My job is to assess risk, and you immediately think, is it a less riskless process involving LedgerComm? Absolutely, than not having them there. And one thing that you think about, like I said earlier, is the counterparty risk. You've got a trade hanging out there. A trade is a trade, and even in the global financial crisis, the leveraged loan market held together, even though, as I said, it's not traded through exchange. But in terms of, we have had issues where I'll share with you, the loan fund that I run has lost economics through some trade mechanics. We haven't responded, or trade's been sitting for a long time. There's some sort of event that's happened on the credit, and it's cost the fund money, and I have to go and then explain it to an investor. And when we're talking about a kind of periodical meetings, we've done this and this on performance, but I do need to show you something that actually didn't go our way because of the kind of way the loan market operates. And I can tell you, the investors who are multi-asset investors will invest across the board will kind of scratch their head and go, okay, well, if you're telling us that is the loan market, that's disappointing on that, but actually, is there not a solution? So I do get asked a lot about the solutions. So no, I wouldn't have any reservation about using LedgerComm or something like LedgerComm. But I think what Will's focusing on is very important, because I can tell you, on a day-to-day basis, sometimes I'm spending 25% of my time on things like this. It is very time-consuming. I did see another question, Ben, just on there on kind of sponsors. Are banks incentivized to kind of move forward, which is something I was saying earlier. Rightly or wrongly, within the leveraged loan market, even if you compare it to the high yield market, the sponsor who is private equity sponsors, for those unfamiliar with that sort of terminology, who would buy or sell these businesses, so own the equity of these businesses, tend to control the syndicate in quite a tight way. So as Will mentioned, whitelist, whether you're allowed to enter the club in primary or whether you're trading, it might be through there. I think I've spoken to a few sponsors and they are keen to have a more efficient market because it's more robust and it has a more diverse set of investors, then that's better for them. And it gives a run for its money with the bond market other than this plumbing, frankly. So I think the sponsors do need to be made more aware of it. I certainly do from an Aberdeen perspective, say, you know, involving someone like LedgerComm in the process would really smooth that flow and provide a better option of choice for the sponsors. So the rights around on the sponsors, and then on the banks, as I said earlier, I think they will get there. It just might be a little bit slower than the investor community, but I think the kind of it's obvious really now that the direction we should be taking.
And as a follow-up,
I think sorry, one sec. I think it's quite interesting, you know, you touched on the sponsors as well, because the very nature of a whitelist, you know, implies that there's kind of a desire for control over your lender base as well, right? And so having real-time access as a sponsor to who all your lenders are, and what your lending capacity is at any one time, is a very powerful tool. Right? And trying to amalgamate that, and it goes back to the question about, you know, can we have software that amalgamates this all across all of the agencies in the market? And I think, you know, anecdotally, I heard from a cap markets guy at a PE firm the other day that, you know, they spend 3 weeks of their year, 3 weeks every 6 months, you know, collating all of their positions and available borrowings and lender information from all of the underlying agents on their deals. And you think about what that costs the firm, right? I mean, you know, you have GPs investing in private equity companies, you know, paying people significant sums of money to kind of collate information by which time you collated it, you know, could well be out of date, right? And so it's having this stuff, you know, the analytics that can be available digitally, I think would be quite powerful for not only for loan funds, but for borrowers and for corporate treasurers as well, right?
I mean, Ben, I was just thinking that yesterday when I was thinking about being on this panel, I thought there is an analogy for the loan market, and I'm old enough to remember when people used to write checks. So you'd write a check. I'd write a check to you, Ben. It's on a piece of paper, okay? It says whatever bank on the top of it, and then it goes into the ether, and it goes through a clearing system as checks used to do and still do, and then it settles when the bank decides it settles. Now, that sounds perverse, but when people move from checks to credit cards or debit cards, people were nervous, but I've always done it by check. And it's actually the same thing. We know that credit cards are safer, quicker, and all the stuff, and it's very much more secure. So I think once animal spirits take over and people realize what Will's saying is a more progressive, it's cheaper, quicker, better, more observable, it will really drive the change. And I think we are at that point now. There's a lot of conversations going on, and people starting to do stuff, including what Will's saying, onboarding with a firm like his.
Yeah, I mean, a very good parallel for that is the kind of buy now, pay later market, right? I mean, in that instance, you were getting charged to use your credit card, the vendor was getting charged for you to use your credit card. You know, the vendor wasn't getting paid for 6, 8, 12 weeks by the credit card companies, right? And that opened up a hole in the market for, you know, the buy now, pay later guys, the Klarnas of the world, right? You know, if you ordered something online and it was something you really wanted, and then you got to the end of it, and when you checked out, they said, yeah, well, thanks very much, we're going to deliver what you wanted in 6 weeks' time. I mean, you just go straight on and hit the back button and cancel it, right? And so I guess that's the situation we're trying to move away from, right? So.
And to follow up on that, Will, so, you know, you've mentioned this 3,500 kind of per trade cost. Do you have thoughts on kind of how much can that actually be slashed down? Like what's, you know, how much of the middle / back office processes can be you know, digitized, automated, helped out, and how much of this kind of cost per trade can go down in your opinion?
Yeah, I guess I don't know, you know, precisely. I guess it's a payoff of, you know, how much, you know, I guess how much kind of human resource you can remove versus automation, right? I mean, there still obviously has to be a cost to producing all of these things. And don't forget, you have to, you know, produce a lot of legal documentation around loans as well. It's not like trading a security where, you know, they go in and out of an exchange and that's that. There there is a cost to producing that stuff. Should it be as high as it is at the moment? Probably not. Could it deliver a better level of service? Yeah, I think so.
Thank you. One that I will take and quickly answer. So what are the key hurdles that you encounter when digitizing the leverage loan financials? I would say the two main issues that we have encountered are developing the right relationships to get as much of the leverage loan universe as possible, to build it out, and to the actual infrastructure around making sure that the permissioning, making sure that only people who are private get to see the information that they are private to. And yeah, to actually then database the financials and show the data. A lot of the infrastructure that we use for that is an infrastructure that we use for the bond side, but it's really the permissioning and making sure that we get access to the financials in the first place, to the lender presentations, and then making sure that the people who are private get access to those same documents is kind of the key hurdle there. And with that, that is all the time we have for today. Thank you so much, Paul. Thank you so much, Will. You've been great.
Thank you.
Thanks to all the participants for joining this discussion. And I would also like to thank Shveta, who was not able to attend and moderate this panel today. A recording of this webinar will be available on ReOrg's platform within 24 hours, along with all our credit data, intelligence, and analysis. We hope to see you soon.
Thank you.
Thanks, man. Cheers.